So welcome to our first webinar dedicated to private debt. This webinar will be moderated by myself, Stephane Prigent, and by Laurent, Jeanmart, our chairman that is based in London. For those of you that do not know us, so we work for Katch Investment Group. Katch Investment Group is an asset management company dedicated 100% to the private debt. We manage a bit more than $100 million asset under management in the private debt space. We have 15 employees and we have 5 offices around the world. We have an office in London where we manage our distribution. We have Luxembourg SICAV with our directors in Luxembourg. We manage the research from Panama. We have an regulated asset management company in Sao Paulo in Brazil that is 100% dedicated to buy local receivables. And we have an office in Switzerland where we offer the service of CIO outsourcing. The objective of this webinar is to give you an introduction to the private debt space and more especially to the liquid private debt. So we're gonna use, we're gonna go through a short presentation of about 15-20 minutes, and after we're gonna open the session for a Q&A. So if you look at this slide, here you can see the returns of the traditional asset classes in 2018, last year, okay? So as you can see, for a portfolio that was only invested in shares on bonds, it was very difficult to have a good return last year. The main equity index, the S&P 500, went down 6%. The fixed income index went down about 3%. And even the most sophisticated asset managers that you can measure with the HFRH index, this index went down also 6%. So if you had a mix of all those asset classes, obviously, would have been almost, and you were well diversified, I mean, was pretty much impossible to have a positive return last year. So what can you do going forward in such difficult time? You can add what we call alternative assets, okay? When we talk about alternative assets, we talk about private equity, real estate, but we also talk about private debt. And the private debt asset class is probably a bit less well known, but for us, it is the most interesting one at the moment. It has a risk-return profile that is extremely interesting, with returns above 8% and a volatility of only 2 to 3%. So I'm going to give the floor now to Laurent that will emphasize the interest of the private debt.
Okay, good morning and good afternoon, everybody. I'm not sure everybody can hear us.
Yes, we can hear you, Laurent.
Fantastic. Thank you, Stephane, for the introduction. Basically, the slide you're looking at here, I'm sure a lot of you will recognize on the left-hand side of the chart that the traditional correlation between the risk and the return of bonds and equities or traditional asset classes. Basically, that's the idea that if you go for more risk and potentially less liquidity, you will get over time a higher return. Obviously, from time to time that's not true, but over a long period of time, generally speaking, this relationship holds true. In private assets, the reality is somewhat different. We find that you don't have to go for illiquid assets to get interesting returns. So if you speak to private equity practitioners these days, they will tell you that on average they expect their money to return somewhere around 8% per annum over the next 5 to 10 years, which is the investment horizon they're requiring from their investors to invest in their fund. And these investors don't know, obviously, or don't really know, let's say, the valuation of their assets until they get the return of their cash at the end of the 5 to 10 years. Okay. So they're within 8%. It's good performance, certainly I think higher than what we will see in the traditional bonds market and in the equities market. But I guess the main point here that I want to emphasize is that you don't need to go for 5 years lock to get that sort of returns. As a matter of fact, our global lending opportunities fund, which is our diversified fund, has a return target of 8 to 9% in USD net per annum to investors. And we basically only invest in liquid private assets. The other important thing to understand is that private assets, have, again, a loose relationship or display a loose relationship between the returns you can get and the risk you're taking. So you can lend money in the private space for a few % a year with a reasonably high risk, or you can, for the same risk, get returns that are completely different. And this is something you don't really see in traditional assets. It's basically, if you take, for example, the corporate bond markets, for 2 bonds of the same risk will not have a spread that is 200 basis points apart. They'll be very close together. That's not the case in private debt. You can get very, very secure investments, very solid investments with good companies for double-digit returns per annum, for example. So essentially, I guess what I wanted to say here is that don't believe the traditional sort of relationship that you see in traditional assets, where there's a relationship between the liquidity and the returns, or the illiquidity and the returns. That's not the case in private assets, or not really the case. There's a very, very loose correlation there. And private assets is an area where active management, active management of portfolio and trying to find interesting opportunities really pays out, because, for the same level of risk, you get very different levels of returns.
So, as Laurent explained, for us, the private debt space is the most interesting asset class at the moment. It offers very predictable performance. The performance would be between 6 and 12%, depending on the underlying strategies. Usually, there is always very strong collaterals. We always look for a level of collateral of about 130%, collaterals that can easily be taken in case of a default and sold. So we always invest in markets where you have a lot of liquidity to be able to resell the collaterals. It's an asset class that offers liquidity. If you're invested in short-term loans, we only invest in loans that are between 1 month and maximum 6-7 months. And finally, you get it's a good asset class for people that are looking for an income, because you get a very predictable return, which allows you to distribute potential income for investors. So if it's such an investment, it's such an interesting asset class, why are we not getting more people being invested in this asset class? Actually, we do. As you can see on the slide here, you can get what we call the smart money, the biggest private equity firms in the world. So the Blackstone, Apollo, Carlyle, and we can see that they all at least double the exposure to the private debt space in the last 10 years. If we take the example of Apollo, 10 years ago, they had about 15% of their exposure to private debt. The exposure is now about 60%. So they actually quadruple this exposure. We think that it is the right time to invest in the private debt space as well. The reason why there are so many opportunities right now in this asset class it's because of the last financial crisis that we got in 2008 when Lehman Brothers went bankrupt. Following that crisis, the regulators in the US and in Europe, they had to introduce new rules in order to reduce the systemic risk of the banking system. One of the most famous rules that they introduced is the Basel III rule that basically impose on banks to have a higher capital reserve. This is important to potentially absorb future losses. As a result, you can see that the performance of the banks are very, very different. If we look at the return on equity of Goldman Sachs in 2007, it was about 30%. And this year, it actually went up a bit, but it is around 10%. So you can see that the profitability and the level of leverage that the bank can have is a lot lower nowadays. Another rule is the Dodd-Frank. Basically, this imposes a bank a higher cost of compliance. The cost of doing business for banks is a lot higher than it used to be. As a result of all those rules, the banks had to exit some businesses that do not longer make sense. And one of them is actually to provide loans to small and medium companies, especially for short duration. If you look at the amount of work that the bank has to do to provide a loan for a 3-month period to a trade finance company, for instance, the amount of work is really, really it's humongous. And the interest that will be generated by this loan is not going to offset the cost of all the work that needs to be done. So they prefer to exit that business. And who took over all that business? The mutual funds. We saw the creation of more than 200 mutual funds over the last 10 years that are now dedicated to private debt. Some are good, some are maybe not as good, and this is our work at Katch actually to identify the best funds to offer the best exposure to the private debt space. As you can see on the slide here, the market share of the traditional banks in the US was about 70% in 1994, so about 25 years ago. And nowadays, it is only 10%. So who took over? Mutual funds, private companies dedicated to provide private loans. What we really like about this asset class is the maximum drawdown that we have had so far with the asset class. As you can see here on that slide, if you look at the worst 5-year performance for each asset class, you can see that some are risky. Global equities, we know that the volatility is high, and the worst 5-year performance you could have got over the last 30 years was about -6%. In the case of private equity, obviously even higher, -16%. But in the case of private debt, the worst you could have got if you would have kept the asset for at least 5 years is 5%. So you can see that we never had really negative performance in any economic cycle so far. Obviously, we cannot predict the future with this asset class. On that slide here, you can see that when we talk about private debt, we actually talk about a lot of strategies. The entire private debt space represents, in terms of volume, it's about $1 trillion. So it's really, really big. Obviously, we have a bias towards the US. And when we talk about private debt, we usually talk about what we call corporate direct lending, when you provide a loan to a company directly. We also talk about the high yield bond space on the bank loans. And together, those two strategies represent about 50% on the entire private debt. We actually do not like that space too much. We consider that there are really too much money chasing those strategies, and some experts are starting to talk about the bubbles. So we really want to move away from those two strategies, and what we focus on at Katch, it's the private lending space, strategies like asset-backed, real estate debt. And so we really focus on only 10 to 15% on the entire space, on short-term duration loans in order to provide liquidity to our clients, and strategy that have very strong collateral. So obviously we are probably not chasing the highest return, but we are chasing the safest strategies. Here you have another representations of the different strategies. As you can see, you have the level of liquidity, and you have the level of duration. If you invest in distressed debt, obviously you have to be invested in 3 years, or at least over a 3-year period. You're going to be invested in what we call closed-ended funds, where you cannot get in and get out easily, and you could get returns around 15%. We do not focus on that space. We focus on strategies that have more a return around 8%, so a bit lower, but those are strategies with a duration between 1 and 8 months, and what we call open-ended funds, where you can easily get in and out. And the strategies that we focus on are trade finance, factoring, receivable monetization, and real estate bridge loan. So Laurent will now present in more details each strategy with the risk-return characteristics. Laurent?
Thank you, Stephane. I am conscious of the fact that you can't see me in video. I'm not quite sure what's happening. I think that Stephane blocked me. I don't know if I...
Yeah, no, we choose to just show the very good-looking people. So now we technically we can only show one person. So that's what happened.
Okay. It doesn't matter, because the most interesting aspect of it is obviously here on the screen. So yes, we as Stephane says, we invest in 4 different asset classes. All of them are quite liquid in relation to what you can find in real assets. You need to be aware of the fact that when we say liquid, that means that essentially when people invest, they can get their money back, within 30 to 60 days, let's say, investing in these strategies. So it's not the liquidity that you're aware of, or that you're experiencing when you trade equities or futures or derivatives, things like that. But we are in the business of serving investors and not really speculators, and therefore for most of our clients this is plenty. Having the ability to invest money and being able to redeem every month is something that generally is definitely liquid enough for our clients. The first strategy on the left-hand side of the screen is factoring and receivables. Essentially, that's the strategy that consists in buying invoices from companies in the view to financing their working capital. So in the last 10 years, in general, and in certain jurisdictions in particular, we've seen an emerging phenomenon, or a growing phenomenon, that is about the difficulty that small and medium-sized companies have to experience to finance themselves. So they can be very healthy companies with a very long track record, a very good reputation, but it's difficult for them to find financing, simply because banks prefer lending to large corporations, and they're not really serving anymore the mid-market as they used to do back in the days when you were running a company and you're going to the the bank around the corner and you would discuss with a relationship manager, it will extend you a loan. That's less and less the case. Today, banks are essentially companies that are whose main operation is compliance, and they don't really have the time to focus on small and medium-sized companies. And for us, quite frankly, it's great because these companies come to us and they say, okay, look, we have serious needs for capital. We have very good orders in the pipeline, but we don't have the capital to satisfy that. Can you help us? And factoring is basically about saying, okay, we can help you. You've got an invoice that you received from your client because you delivered good or services to your clients. This invoice will be paid to you within 30 days or within 60 days. We'll buy this from you at a discount. And that discount can be anywhere between 1% per month to 3% per month. So something that is extremely interesting for us, also because the actual default rate in the strategy, depending on where you do it and whether the people who do it properly, but the average default rate is somewhere in the region of 1 to 2% per annum. So something that is very profitable when you do it properly. It's labor intensive. If you're willing to put on the work, then it's something that is completely uncorrelated, that tends to return positive performance every month, and therefore for us it's something that to which we have a pretty sizable exposure to. We think we can get anywhere between 8 to 20% per annum investing and deploying capital in factoring. The second strategy is direct lending. So as Stephane alluded to, again, there's a big shortage of capital for corporations. If the global economy grows at 3 to 4% per annum on average, well, you have to have enough capital to fuel that growth. And banks, again, don't do that. They're not in the business anymore of financing the bulk of the economy, which is the mid-market. And so you have now and then opportunities that come across your desk where very solid companies are willing to pay double-digit interest rates for financing that comes with a lot of protection, so personal guarantee, a decent liquidity, so not too long. And therefore for us it's always very interesting opportunities. These are deals that we look at very closely when they are interesting, but obviously it's a lot of work, but once you've done it, then it pays off quite handsomely. And in fact, if you structure it properly, it tends to pay even more if the company defaults, because you have penalties, you have things like that, and essentially your rate of return tends to increase even in case of default. So that's always very interesting. The third strategy is bridge financing. So typically we do that in real estate. So again, always the same common theme, which is a shortage of capital in the market. There are developers that, developers tend to always be a little bit short of capital. They fund oftentimes their project with their own equity, but now and then they have a need for, they have a shortage of capital, and what happens is that they tend to need a bit of cash to bridge them over to the next opportunity. And that's, for them, if they don't find capital, it's very expensive because they have the equity sitting there idle. They can't finish a project. They need to recycle this capital. And so what they do is they essentially come to people like us and they say, okay, I've started a project 2 years ago where I'm building 50 flats. This is costing $20 million. Basically, I need another $5 million to finish the project and being able to sell those flats. And by the way, the selling value in current market of these flats is $50 million. Would you be able to help us? And we say, yes, of course. We'll lend you money for 24 months. We'll charge you an interest rate of 13 or 14%. We want to have the entirety of the project as a guarantee. And we also want your personal guarantee, you, the CEO of the borrowing company, on top of everything. And most of the time they say yes. So for us, again, very profitable strategies, very safe. You have the advantage of having real assets as collateral, something that you can sell reasonably easily. I mean, it would take 3 to 4 months to sell those flats at a good price. But for us, it doesn't matter because in the meantime, we paid our interest and we paid some penalties as well, again. So that's our third strategy. And the last one is trade finance. Trade finance is something that I know a lot of you are familiar with. It's effectively the strategy that consists in financing the transportation of commodities. So commodities are produced in certain countries, such as Brazil, for example, a producer of large amount of, let's say, for example, copper or sugar, or Africa, or even Canada. Canada is a big producer of oil. North Africa also a big producer of oil. And all these commodities are obviously, at least for the large part, not consumed where they are produced. What does that mean? That means that someone has to take that commodity and ship it over to the countries, or let's say mainly to China, to consume those commodities. And that has a cost, and that cost is not trivial. When you ship a cargo of oil, you're talking of millions of dollars. And so producers of commodities are not in the business of financing that. So what do? They go and see a physical trader and they say, okay, well, I've got X amount of such commodity to ship to China. I am based in Turkey. Can you find us a boat and ship the commodity? And for this, I'm going to pay you a rate of interest of, let's say, 8 to 12% per annum. What's interesting about this strategy is that it comes with a lot of guarantee. So the cargo, the commodity that's being shipped, is guaranteed by an insurance. It's insured in case of loss. The structuring of the payment is a little bit complicated, but typically it boils down to being able to make sure that the other side is going to pay. So it comes with what is called a letter of credit, typically, which means that someone somewhere is taking the cash that is needed to pay for the cargo in advance. And so all that results in performance that is extremely stable, very, very stable. Trade finance has been in existence for in the current form for 2,000 years. Some great people have taken advantage of it to build massive fortune. Like, for example, John Rockefeller started in trade finance, shipping commodities, doing exactly that. And so you get, as an investor nowadays, shipping commodities, you get somewhere in the region of 6 to 10% per annum. Very interestingly, if you look at the performance of that strategy in periods of stress like 2008, you can see that the performance really doesn't move. It's exactly the same in 2008 as it is in 2015 or 2007 or 2012. It's basically always the same rate you're getting. So it provides a lot of stability. It has the default rate that is consistent with a AA rated bond, so extremely solid bond, but the yield is about 3 times as high. So very, very interesting. And so what we're trying to do is combine those 4 strategies, make it as diversified a portfolio as possible, to be able to generate the dividend that we need to distribute to our clients when they choose distribution. And just for those who don't know, we distribute 6% per annum on the distribution share class in dollars. And our objective is to generate 8 to 9% per annum net of all fees to our investors.
Okay, thank you very much, Laurent. So we're going to open the session now for Q&A. You can easily ask your questions if you go to the bottom of your screen, and you should get the options to either raise your hand or ask a question. So you can start to ask your questions now. So we got we got the first question, Laurent, which is regarding the sensitivity of the strategies that we presented to the evolution of interest rates.
Okay, that's a very good question actually, because at the end of the day, you know, we are in credit, so we're doing credits, investments, credit-based investments. So, you know, if you invest in our strategy, you would be entitled to think, okay, you know, this is interest rate based. What happens if interest rate go up? Typically, my bond portfolio goes down. So what's happening to this strategy? And the short answer is that typically the strategy is not at all sensitive to interest rates, or if anything, if interest rates go up, we tend to make more money. So it's almost as if you had a negative correlation with traditional bonds. And why are we making more money when interest rates go up? Simply because it's almost an opportunity cost. You know, if interest rates go up by 0.5%, not much is going to happen to the company around the corner trying to find financing. But if interest rates go up by 2 or 3%, then of course it's going to be for them even more difficult than before to find financing, and basically more and more people are going to be attracted to the government bond market, which is yielding more, and so there's even more shortage of capital in the private space. So, for example, if you look at what happened in Brazil in the last 5 years, Brazil is a very interesting country because it's a country that is very heavily using the factoring business, the factoring opportunity to finance small companies, small and medium-sized companies. And 2-3 years ago, interest rates in Brazil were 14%. And what you saw is that factoring rates were sort of loosely correlated to the level of interest rates in Brazil. So when interest rates started to go up a few years ago in Brazil, then what you saw is that you can actually buy invoices at a larger discount than previously. In other words, you were making more money. And so that kind of explains to you a little bit why we think that, if anything, the correlation of your traditional bonds portfolio and that of private debt, liquid private debt, is basically 0 to slightly negative.
Okay, thank you, Laurent. I think I'm going to answer the next question because people can see me and they cannot see you, unfortunately. And I don't know, we'll make sure that we fix that for next time. So we have another question regarding the geographical exposition of our strategies. So for the multi-strategy fund that we manage, we tried not to be actually focused on one specific country. We do diversification in terms of strategies, but also in terms of country exposition. So at the moment, for instance, our largest exposure is to the US, where we have about 35% exposure. It makes sense because it's in the US that you get most of the private debt strategies available. But we also have exposition to Brazil for about 25%, to Europe about 30%, and finally a little bit of exposure to Asia as well. So the idea is not to get any country risk, but on the other hand to diversify as much as possible. We have a question regarding the hedging, obviously, of currencies. That's always a question that we get. All of the currency exposure are 100% hedged. When we invest in euros, we hedge it back to dollar. that's the kind of hedging that is really easy to do with forwards. When we invest in Brazil, obviously the hedging is a bit more complicated. We tend to do it with what we call spread over a period of 3 months, and we roll those spreads. So we typically buy a call options and sell another one at the same time to reduce the cost of that hedging strategy. What else do we have? We have questions regarding the liquidity. Regarding the liquidity of the multi-strategy fund that we offer. So what we do is with our multi-strategy fund, we offer a monthly liquidity. We offer a monthly liquidity, and we are invested in strategies with duration between 1 and 5 months. The average duration is about 2.5 months. And which is good with those short-term loans is that all the time you get loans that come to maturity. And so you get flows that always come back to the underlying funds in which we are invested, and this is how we manage to provide this monthly liquidity. Do we have more questions? I mean, I do not see more questions. If not, then I will thank you very much for our attention today. And please, if you have any questions for us, do not hesitate to come back to us directly by email or by phone. Thank you very much again for your attention today.
Thank you, everybody.